and welcome to Sectors Up Close. I'm Emma McCarthy. As the COP26 summit in Glasgow wraps up, our focus today is on ESGs, and my guest is Bob Jenkins, Global Head of Research at Refinitiv Lipper. Well, climate change and the environment are certainly at the forefront of the minds of everyone these days, and investors in particular. But what does it mean for investors, especially when faced with countless ways to measure ESG investing? This is one, the S&P 500 Environmental and Socially Responsible Index. It measures the performance of securities that meet their definition of ESG criteria. It's up 27% this year, so it beat the wider market by 3 points. However, the top 10 constituents in this index include big energy users, tech names including Microsoft, Apple and Amazon, as well as JP Morgan and Johnson & Johnson, not names normally associated with environmental advocacy. So for more on this, I'm now joined by Bob Jenkins, the Global Head of Research at Refinitiv Lipper. Bob, thank you so much for joining me. As I just said, big tech names, and then JP Morgan, Johnson & Johnson, they're not exactly names that you'd associate with environmental work. So how would you define an ESG?
That's the million-dollar question, right? I mean, in some cases, particularly if you think about renewables, it's an easy answer. So if you're a solar power company or a wind turbine manufacturer, that's an easy answer. But when you start looking at, particularly under the environmental pillar, say companies that are transitioning to a carbon-reduced world, if you will, how do you really metric that? And do we have all the proper tools and disclosures to do that? And unfortunately, we don't.
So Bob, would you consider Facebook or Microsoft then an ESG?
Well, you know, Microsoft, I would, and they are actually the most popular ESG holding, and they're the most popular number one holding if you look at both active and passive. Facebook is getting kicked out of the ESG club a little bit of late, and for good reason. We've all seen what's been going on in the news with Facebook. And in fact, what I've noticed, particularly because I follow the active and passive fund holdings, they've been kicked out of the active funds even quicker because it's kind of a bad face to have on the fund at this point in time, given all that's going on around Facebook and how they run their businesses and really how they handle and manage data that comes into their businesses. So I would say at this point in time, Facebook is starting to find its way out of the club. Even though they've changed their name now to Meta, they're trying to hide a little bit. I'd say right now they're on the way out.
And how have ESGs performed historically, and how do you think they're going to perform in the future? I mean, just look at Glasgow now. Sustainability and the environment is really at the forefront of everyone's minds. Do you see them really taking off?
You know, it's funny what you just mentioned at the outset in terms of what they're holding now is really telling as to how they've been performing of late. But if you think about the history, really these grew out of the 70s, 80s, and 90s. A lot of these funds were focused on, say, religious or ethical concerns or, of course, environmental concerns. And they largely tailored to a very exclusionary approach where they essentially eliminated entire industries, like the sin stocks were eliminated, or energy stocks. And if you think about the 70s, 80s, and 90s, these are all really good companies. They generated great cash, great dividends, and ESG funds didn't benefit from these really strong performing companies at the end of the day. And in fact, what happened was they became very cyclical, very volatile, and they earned a reputation, deserved, as underperformers. But as ESG has kind of came into the vernacular over the past 8 to 10 years, that's really ramped up companies who weren't traditionally ESG managers to come into the space and launch products. And right now what they've done is they've gone with the familiar. They bought in the tech names, the large cap growth stocks and such, which by and large have a good E footprint, right? So you can kind of see why they did that. And again, they're comfortable with it. It's what's in their non-ESG funds. And what has happened is they've also excluded energy, is they've really followed that growth trajectory, which has been extraordinarily strong and dominating for a good decade now. So ESG funds of late have performed really well. However, they got into the pandemic, and then we came out of the reopening trade. And about a year ago now, when vaccines came into play, all of a sudden the value trade started to lead the markets a little bit, and ESG funds started to underperform. And they've kind of gone back and forth over the course of 2021. And even as recently as Q3, we've seen a lot of the tech and growth names kind of came back a little bit, and ESG funds, as a result, underperformed. That's reversed in the first part of Q4. But I think now that, for instance, the new Pfizer drug is out, if we can get COVID back to an endemic type of phase, I would watch out as whether or not the value trade and the reopening trade start to take over and ESG starts to underperform again.
What kind of advice would you give investors when they're looking to select an ESG?
It's very difficult, right? Because there is a lot of ratings providers out there who do a really good job with really bad data, unstandardized data that comes in, and they're doing the best they can to make the sense of it. But at the end of the day, what comes out of their engines, if you will, are sometimes differing opinions, sometimes slightly different, sometimes widely different. And as a retail investor or an advisor, you look at that and it's kind of confusing and a little frustrating. I would recommend what you do is look down at the pillar level. Most of these agencies do allow you to get this data free of charge. You can just pretty much pull it up on your computer, drill down and see if you find consensus at the E, S, and G level. That's a good way to try to understand if it's really aligning to your values.
Bob, thank you. That was Bob Jenkins, the Global Head of Research at Refinitiv Lipper. Now, before I go, let's take a look at some of the main environment headlines. The United States and China unveiled a deal to work together to tackle climate change on Wednesday by cutting methane emissions, phasing out coal consumption and protecting forests. US climate envoy John Kerry says the agreement was a statement of support for a successful United Nations climate summit, with both taking a step towards closing the emissions gap.
But let me be clear. This declaration is a step that we can build on in order to help close the gap. You know the expression that a journey of 1,000 miles begins with a single step. Well, every step matters right now, and we have a long journey ahead of us.
Swedish car maker Volvo said on Wednesday it had set a price on carbon emissions from its operations of 1,000 Swedish crowns, approximately $116 a tonne, as it attempts to ensure all future projects are sustainable. Volvo made the announcement in Glasgow as it joined an initiative to phase out fossil fuel cars and vans. The company said it had deliberately set a relatively high price to, quote, future-proof itself. Volvo said it was the first automaker to set such a price across its whole operations as part of its aim to be a climate-neutral company by 2040. And finally, drone footage on Thursday in New Delhi showed Hindu devotees taking a dip right by toxic foam in the Yamuna River. The New Delhi Water Supply Board has blamed industrial waste and untreated pollutants from neighbouring states for the worsening pollution. And that's a short roundup of ESGs. I'm Emma McCarthy, and this is Reuters.